In this video, I'm going to break down the easiest way to make money in real estate with no tenants. I know, sounds too good to be true, right? In this video, I'm going to break down a way to get exposure to real estate as an asset class. Remember, this is according to my research, not financial advice. Don't go aping into anything after watching this. I do have a free newsletter if you do want to keep up to date with markets. Link to that will be in the description. Most people think real estate investing means tenants, mortgages, maintenance, and it doesn't have to be. Most people think you need a deposit, a mortgage, the tenants. You've got things like stamp duty, you've got taxes, you've got people calling you at midnight, you've got things breaking, you've got a lot of complexities, and you've got obviously debt. Now, the mortgage debt can be good debt, but it comes with a personal liability. As I mentioned, a buy-to-let mortgage can work, but you are personally on the hook. If interest rates change, the tenant leaves, cash flow can easily turn negative. But there's a much simpler way to actually get access to real estate, the same asset class with none of this rubbish, you could say. And that's a ETF, a REIT ETF. I know you're disappointed, but let me just break it down because this could be a good way for you to get exposure to real estate or property as an asset class. So a REIT ETF tracks an index of publicly traded real estate investment trusts. So you're in a slice of professionally managed portfolio, commercial, residential, industrial, data centers, logistics, and so on and so forth. The Dow Jones US Select REIT Index is designed as a proxy for direct real estate. So it excludes companies whose performance is driven by factors other than real estate value. So it's pure exposure to the real estate asset class. So REITs are required to distribute the majority of their income as dividends. So regular income from real estate without chasing rent payments or managing tenancy agreement, tenants, all these type of things. There is different ways to get exposure through these ETFs that do track real estate, but I've sort of chose REITs in this one, but I definitely would do your own research and check them out. But you can just buy and sell in seconds and you've got no house to sell, right? Everyone knows the housing market at the minute. You might list a property, it might take ages to sell, and then people will say you never sell, but you could be cash flow negative. So there's all these factors, but if you want exposure to the buy and hold real estate as an asset class, it's definitely a way to do it. So as you can see here, we've got the chart here. So as you can see, REIT on the Dow Jones All Equity, REIT ETF has just gone up and up and up. So it's 5x from the 2009 low, which compared to some asset classes may not be as good, but it's a good diversifier from maybe away from stocks and other investments. So as you can see here, it's at it's all-time highs, it's doing really well. Some of the other real estate ETFs, they're not doing so well, but this one definitely is the strongest. But as you can see here, you've had exposure to the increase in property prices, and you can see we had a massive spike in COVID in and around there. And yeah, just a great way to get exposure to a different asset class without the tenants. So one of the risks, obviously, for property is interest rates. Now, we've had interest rates pretty much, zero, they're insane. We've had very low interest rates in this period. Now, are they going to go back up to this, 1980 period? Probably not, but a risk could be higher interest rates, right? So as you can see, these are the US interest rates. So these are on a weekly chart basis. This is obviously a risk for real estate. When rates rise, mortgage costs rise, hurting housing affordability, and then obviously the REIT returns. But 2002, the REIT sold off almost happened when the Fed started hiking. High borrowing costs, it makes it less of a desirable asset to be in. And yeah, as you can see, it's very low at the minute, but it'll be interesting to see kind of where it goes to. But that is definitely one of the risks with real estate investing. The debt argument. So look, good debt without personal risk. So as you can see, everyone talks about you go into debt, you buy the real estate and all that sort of stuff. Well, buy-to-let mortgage is described as good debt, and it can be. The tenants serve the mortgage. So let's say the mortgage is $200 dollars a month, and the tenants pay $400. You are $200 cash flow positive, and the asset appreciates over time, so you can have tax write-offs and all that stuff. In theory, it works well, but interest rates can create a bit of mess when it comes to this, and especially maintenance as well. Like if you've got a broken fridge or whatever, I don't know, that would take off the rent, for example, the cash flow positive that you are in. So REIT ETFs benefit from institutional leverage without the personal liability. So the properties inside the ETF are financed professionally, so you can get the return from leveraged real estate without a mortgage in your name, and you don't need to be on the hook for hundreds of thousands of debt. You don't need to go in debt for this. You can just invest it passively, and it's a really good diversifier, as I mentioned, from stocks and other investments. So look, I think one of the misconceptions with real estate is, do you give it to a company to manage and manage all this stuff? But will that take away from your cash flow? That's obviously an argument. But if you're doing the management yourself, you've got tenants, you've got the debt, obviously, to manage. You've got, people coming in and out. So you might have your property vacant for a couple of weeks or so. You've got various, taxes, fees, all this sort of stuff. This takes all the guesswork out. So this is essentially a way to get exposure to increased property prices without all the hassle. Now, you're not going to have the cash flow, but you get some dividends. The dividends obviously won't be as lucrative, but if you can apply a long-term mindset and say, okay, cool, where do I want to invest? Or if you think of like a Ray Dalio approach of like, okay, cool, I want, uncorrelated bets, this could potentially be a good one to throw into that mix. And as you can see, what I'll put there, you can sell whenever you want. So definitely, a thing to consider. So the verdict, a REIT ETF is designed as a direct proxy for a real estate investment. Interest rates, obviously they're at, a low compared to what they have been at. And, typically, when they go higher, it's less lucrative for the asset. So a monthly chart is at all-time highs. That REIT ETF is doing well. It's 5x from 2009. You could argue that's not too good compared to some other assets out there, but definitely one to consider. If you do want to keep up to date with more market stuff, you're probably disappointed thinking, oh, God, boring. I wanted to buy houses, without any tenants and all that. But if you do want to keep up to date with markets, that's what I do talk about. Link to that will be in the description. See you in the next one.